Hello friends, how are you all doing? Hope you all are doing great at home. Sabi Akther from here, an associate affiliate, a lecturer, and a coach for all ACCA students who are going to give upcoming exams, right? So you have so for the ones who haven't subscribed to my channel and who is seeing this video for the first time, yes, there's a YouTube channel. Uh, the name is Sabi Akther. That's my channel, and I have uploaded all the advanced financial management, that is AFM videos, and few of the SBR questions and SBL too. So you can go and check out those videos. I have finished the AFM course, so whoever wants to give exam for June 2021 can access that all the questions I have solved from revision kit, and also the the entire syllabus is covered. Now what's new in this video is I have come up with this new course, which is financial management. I'm touching this paper. I'm going to finish the entire course. I'm going to upload videos covering the entire syllabus of FM. And it's a great news for all of the students who is planning to give FM but who cannot afford to go for a classes, or if you have to go for online classes, you have to pay huge amount, right? So the great advantage for you is no money will be wasted. Cost is zero because this is free of cost. It will be uploaded on my YouTube channel, Sabi Akther. Every day I will be uploading videos, so you can go through those videos, access those videos number of times, share it with your friends, ask me doubts personally, and I'll be here guiding you, solving all the doubts for you, right? So here, my friends, again, let us start this. So this video is the first video which I'm going to start FM, financial management. Now, the question, before I ask financial management, right? I'm going to be very flexible here. I'm going to be very, what do I say? I assume that you have no knowledge of financial management, zero knowledge of financial management. Even if you have, some of you will be having vast knowledge of financial management. Maybe you have done some degree level of before and then got exemption and then came to ACCA. That's great. But I also have to consider those students who does not have any knowledge of financial management. What is financial management all about? What does it include? How it will be tested? How it will be marked? Is it tough? How much time do I need to finish this course? Is it numbers? Is it theory? What is it all about? It's all a mess, right? Isn't it so much of confusion? Don't worry, my upcoming videos will make this very clear to you what is financial management all about, and trust me on this. In this journey, okay, this is your journey with me on financial management. It's going to be very easy, right? Financial management is not at all a tough subject. In fact, it is one of the subjects which I love, I enjoy personally. That is the reason I've taken AFM classes also. You can see my videos for the new subscribers if you're planning to thinking whether you have to subscribe or not, and also for the one who is seeing my video for the first time. But for my subscribers, they already know that I've done AFM before. So it's usually that you go from it's little funny because usually what happens is people progress, right, from AFM they go to AFM. For me it is like I'm coming backward, you know. From AFM I'm going coming down to FM, which is okay, I don't mind, as long as it's all about finance, accounting. You know, I can teach this course anytime, any day, free of cost. I don't mind, because this is not a money making thing for me, right? I am teaching this course out of passion, and I also have I get requests from all of the students who are struggling for FM, who are not getting a good teacher for financial management. And considering this corona, this COVID-19, I know that you will be at home, sitting at home, don't know where to go, no one to guide. Trust me on this. This is going to be a great time for you to invest, because if you check on YouTube also, you will rarely see any such video who will give tip. And by the way, for your before you start the course, make sure that you have the revision kit. You need two things. One is revision kit, one is your textbook. It could be BPP, it could be Kaplan. There is no, don't try to use two books. It's my advice. Please, I humbly request all of you, don't use two books. You'll be wasting time. You'll be getting stressing yourself more. It does not matter which book you use, whether BBB, whether right Kaplan. At the end, you have to solve the questions. You have to get the same result, whether BPB or Kaplan. But I am using Kaplan here throughout the course. All the revision kit questions are from Kaplan. Even the textbook I'm using is Kaplan. So starting today, let's start on this great journey. Good news. Okay. So here I am, FM syllabus. Before we know what is financial management, we have to go through the syllabus. You know, you have to go deep into the syllabus. If you don't know what is financial management all about, then how will you be interested to study this course? Tell me, my dear friends. So that's why going through the syllabus, your syllabus is there online in your ACCA website. Please go and download it and actually do make some time to go through it, right? But if you can't, no worries, you can check this video. This video will, and do watch this video till the end, because this is going to solve most of your doubts by just this one video. I guarantee you, this one video, if you watch till the end, you will get a clear picture, crystal clear picture of what AFM is all about, what are the things it considers, and whether you will be able to do it or not. And have you heard things before, or is it completely new to you? You'll be able to get some idea about it, because the whole syllabus is there in this video, what all things is going to come. Of course, I'm not going to explain each and everything in detail now, because that we are going to do in upcoming videos later in future when we are actually going through that area. Right now, I'm just giving you a brief introduction and what under each section it includes. Okay, so starting with the main areas, there are 7 sections in FM. Okay, 7 sections, section A, B, C, D, E, F, G, as you can see on your screen. These are the main areas. These core areas are subdivided into many other areas, many other parts. Okay, section A, financial management function. What is the function? What is it all about? This is relatively, it's like a theory part, not numbers. It's going to be, it's easier, right? It is the easiest thing in this. We are starting in this order only, right? And when you study also, it's my request, please, if you're planning to study FM, for all of those who have some knowledge about FM, right? Who have maybe done some courses, degree courses, or have done FM and got the exemption when you came to ACCA. For them, when you do AFM, right? Not FM, AFM, that will be, then you can do it in any order because you know the whole syllabus. But for FM, since you don't know the whole syllabus, you don't know which area is easy, which area is hard, I recommend when you study also, start with section A first. Okay. In fact, I even have a great news for all FM students. If you want, you can email me if you want. I have made a timetable for FM. So all those students who want to study FM from home and don't know how to study and divide it, I have made a beautiful timetable, and it actually works for students, right? So starting with section A, financial management function, then we have section B, financial management environment, right? Then we have section C, working capital management. Now, accounting student, you know what is working capital, current assets minus current liabilities. You are taking your current assets and current liabilities, you are dealing with these two things, right? Section D, investment appraisal. Investment appraisal is a long-term project you are investing, right? What are the all things required there? And trust me, investment appraisal and risk management, these two areas, section D and G, are the most interesting section of the syllabus. I don't say other sections are boring, but compared to other sections, these areas are, it's like numbers, so you will love it. It has a lot of calculations to do. Now coming to section A, business finance. How do you finance a business? It's very important that how do you finance a business. Financial management means what? You're managing your finance, right? So business finance is all about your debt, your equity. Are you taking a loan from the bank to finance your business? Or are you going by your return earnings, equity, all those things? We have so much. It's a vast topic, right? Coming to section F, business valuation. Now I have done a course on this also. And I've got a certificate on business valuation course. There's a course on ACCA page, right? Most of you are not aware of it, right? It's optional. If you want, you can do it. I have done it. So this will help. Also will help me to give you a great insight into this business valuation, right? Business valuation is, I will not say it's very easy. It needs practice, more practice, because candidates can make mistakes in business valuation. It's a little tricky, tough to understand, but once you understand it, you'll be able to get it. And finally, section G, the risk management. The easiest is risk management, I would say. Investment appraisal and risk management. Risk management is all about your currency risk, your interest risk, how you are hedging, how you are managing those risks, right? Because in a business, risk comes. With finance, everything comes. Working capital, the finance, the valuation, the risk management. So these are the 7 areas. I hope now you're a little bit familiar. Now starting with section A. Under section A, these are the subtopics we have. Number 1, nature and the purpose of financial management. Okay. What do you have to do? Explain the nature and the purpose of financial management. We'll be doing this. Today I'm just going through the syllabus. I'm not teaching anything. So from tomorrow I'll be teaching, right? Next video. Next, explain the relationship between financial and management accounting. Right? So if you have done, so you will be knowing what is financial accounting, what is management accounting. You have done this courses, right, before you came to FM. So now what is FM? You are linking this. Next, number 2, financial objectives and the relationship with corporate strategy. Now you know that every company has some financial objectives. Financial objectives mean everything you are relating to finance. There's a finance department in a company, you have a finance director, objectives, and you have a corporate strategy. Corporate strategy means the overall goal of the company. Financial objectives is one part of the corporate strategy. So what is the relationship with that? Discuss the relationship between financial objectives and corporate strategy, right? Next, identify and describe a variety of financial objectives, including, so for you to understand it better, what are financial objectives? Financial objective is something which is like money term, right? You can measure it. So like including shareholder wealth maximization, how much the shareholders wealth has been maximized. It's a financial objective, something relating to wealth or money. Next, profit maximization. Profit is in terms of number, right? Anything which is in number is financial objective, remember that. Even wealth. Next, earnings per share, your EPS growth, how much it increased. Even this is financial objective because it's finance, it's with numbers. Next, we have more in section A. Stakeholders and impact on the corporate objectives. Don't forget about the stakeholders. You'll be wondering why stakeholders in financial management, because even in financial management, stakeholders comes everywhere, right? Next, in this, under part 3, we have identify the range of stakeholders and their objective. This shall be easy for you to do because you have done management and accounting, F1, I think. Yeah. So that is range of stakeholders. There you know what are the stakeholders, connected stakeholders, internal, external, and what are their objectives. Next, discuss the possible conflict between stakeholder objectives. You know that the two stakeholders, sometimes they make a different objectives which conflicts with each other. Next, discuss the role of management in meeting stakeholders' objective. You know that manager are the agent of the shareholders. So how well they are meeting the stakeholder objectives. Agency theory, right? Next, describe and apply ways of measuring achievement of corporate objectives. So these are the corporate objectives. What are they? How can you measure the corporate objectives? Ratio analysis, very important. Being an FM student, if you are not able to calculate ratios, you should not even sit for FM exam. You have to be very, very thorough with your ratio analysis. You have to know each and every formula, right? So what are this? Such as return on capital employed, return on equity, your EPS, your DPS, right? Dividend per share. This, as an FM, you should know what is the formula for dividend per share, earnings per share, return on capital employed. These are like your daily ratios. You should know it. Changes in dividends and share prices must, as part of total shareholder return, you have to know it. Even if you are not writing anything on this, but remember, financial management F9 or FM has MCQs. in section A, part A of your exam. So you should know. If they ask you what are the two things which is included in total shareholder return, you should be able to say changes in dividend and share price. Dividend and share price. So as an MCQ also you have to know, right? Next, explain ways to encourage achievement of stakeholder objectives, including what are those? You can give them share options or performance related pay. All this you should be able to know. Some of the things you know from your earlier studies. This is not something very hard. It's like theory part, and we can just quickly go through these areas. Just briefly we'll touch this area and then we can finish it off. It's like reading. Okay, nothing for me to teach you extra. But still I will do take time and teach for those students who doesn't have prior knowledge of this area. So regulatory requirements such as corporate governance code, best practice, stock exchange listing regulations, all these things. Financial and other objectives in the not-for-profit organizations. What are those? Discuss the impact of not-for-profit status on financial and other objectives. Discuss the nature and importance of value for money. Now, value for money comes in where? Public sector or not-for-profit organizations. Remember the three is economic efficiency and effectiveness. These are the objectives. Next, discuss the ways of measuring achievement of objectives in not-for-profit organizations. Next, we have section B. So we have moved to section B now, which is financial management environment. What is the environment there? The economic environment for business. Identify and explain the main macroeconomic policy targets. Now you should be knowing what are the macroeconomic policy targets. Define and discuss the role of fiscal, monetary, interest rate and exchange rate policies in achieving macroeconomic policy target. Right? I'm assuming that you know fiscal, monetary. If you don't know, don't worry. Throughout the course, you will know it. Explain how government economic policy interacts with planning and decision making in business. Right? The government is also important because this is about environment. Environment means what? You are including all the stakeholders, all your macroeconomic factors, right? Outside the environment, which is not in your control. Explain the need for an interaction with planning and decision making in the business of what? Competition policy, government assistance for business. Remember, government give assistance like grants or subsidies. Green policies they give for investing in green technologies, and corporate governance regulation. Now everything you don't have to write. Okay, so don't think that how will I memorize so much of thing. Most of the thing will come as MCQs, right? So that's a great news for you. Next we have nature and role of financial markets and institutions. This usually they don't ask as a question. It might come in MCQ. We'll work through all the MCQs also, so don't worry. Identify the nature and role of money and capital market both nationally and internationally. Explain the role of financial intermediaries. What is it? We'll know it. Explain the function of stock market and corporate bond market. Okay. Explain the nature and the features of different securities in relation to a risk-return trade-off. Next. 3. Nature and role of money market. So what is money market? Understand from this. Describe the role of money market in. Money market is all about short term. Right? Providing short-term liquidity to the industry and public sector, providing short-term trade finance, allowing an organization to manage its exposure to foreign currency risk and interest rate risk. Next, explain the role of banks. Remember, banks also will come here. Financial environment. So bank also will come. Other financial institutions also will come in the money market. Explain the characteristics and role of the principal money market in instruments. Interest-bearing instruments, discount instruments, derivative products. We'll throughout the course we'll know all this. Next, section C, working capital management. This shall be easier for you. Okay, so the nature, elements and importance of working capital. Describe the nature of working capital and identify its elements. Identify the objectives of working capital management in terms of liquidity and profitability and discuss the conflict between them. Discuss the central role of working capital management in financial management. Number 2, management of inventories, accounts receivable and accounts payable and cash. Remember these 4 areas in working capital management. One is what? Inventories, your stocks. One is account receivable, your debtor. One is accounts payable, your creditor. And cash. Cash is a current asset. So these 4 areas you should know how to manage. Because finance management means what? You are managing all this. In the financial management, you have to manage all this. All these are your finances. If you are not managing your inventories, if your cash is not managed well, what happens? What happens? You will be out of the business. Yeah, right? You'll be the next day you'll be thrown out of the business. Will not survive. That's why financial management. Now, do you understand why financial management is very, very important? Financial, you need to manage those finance, the money you have. You need to control. So cash is one out of them, very important. Even inventories, even your account receivable. Next, explain the cash operating cycle and roles of accounts payable and receivable. This is very important. Explain and apply the relevant accounting ratios. What are those ratios? Let's see. First, current and quick ratio, you shall be knowing it. Inventory turnover ratio, average collection period and average payable period. Sales revenue, net working capital ratio. Discuss, apply and evaluate the use of relevant techniques in managing inventory. You need to manage inventory. You need to know, for that you need to know this two things: economic order quantity model and just-in-time techniques for inventory managing. Next, discuss, apply and evaluate the use of relevant techniques in managing account receivable. What are they? For accounts receivable, your debtor, you have to see how you have to assess their credit worthiness. Are they able to pay you back or not? Because what happens if they're not able to pay you back? You will suffer, right? Let's say your customer have taken a credit from you and they are not able to pay you in the due time. What happens? And that time you're short of cash also. But you have to pay your supplier, you have to pay your rent, you have to pay to the bank the interest and loan. What happens? How will you survive? That's why it's very important for you to manage your account receivable. You have to assess their credit worthiness before you give credit to your customers. Next, manage accounts receivable, right? Same. Collecting amounts owing, you have to collect the amounts owing. Offering early settlement discount, sometimes you will even give discount to them so that they pay early. Using factoring and invoice discounting, these are the two different things you'll be learning. Managing foreign accounts receivable, yes, we are already not doing businesses locally. Now we are going to the international scenario where we're doing businesses internationally, where we are going to deal in foreign accounts receivable, right? Next, accounts payable, how you are going to deal with it. Trade credit effectively, yes, you are taking effect credit. Evaluating the benefits of discount for early settlement and bulk purchase. If you buy in bulk, we know that you get discounts. So what are the benefits? Evaluated. Manage foreign accounts payable, same like receivable, we have foreign accounts payable also. Next, explain the various reasons for holding cash. Now, sometimes you are not investing your cash, you're holding that cash. What are the reasons for that? You need to know it. Discuss and apply the use of relevant techniques in managing cash. What are they? Number one, preparing cash flow focused to determine future cash flows and cash balances. Yes, you have to prepare cash flow. That is one way you can manage cash. Next, assess the benefits of centralized treasury management and cash control. What is this treasury management? We'll come to know throughout this course, right? Centralized and decentralized. These are the two ways a treasurer can manage. Okay. Cash management models such as, there are two models, Baumol model, I guess that's how you pronounce, and the Miller-Orr model. So these are the two models for cash management you should know in this course. Investing short term. Next. So you see, working capital management is quite a lengthy area where you need to focus. Determining working capital needs and funding strategies. How you are going to fund working capital if your liabilities are more than assets, right? So calculate the level of working capital investment in current assets and discuss the key factors determining this level, including length of working capital cycle in terms of trade, and organization's policy on the level of investment in current assets. Industry in which the organization operates is very important. Some companies, industry will be having a longer working capital, and that is normal. Some will be having a smaller working capital cycle, and that is normal depending on which industry you operate. Next, describe and discuss the key factors in determining working capital funding strategy. How you're going to fund working capital. For that, you need to do distinction between permanent and fluctuating current assets. Relative cost and risk of short-term and long-term finance. Yes. Matching principle. What is matching principle? Matching principle, what is it? If you buy a short term, if you take a short term loan, right, you have to invest it for something which is short term in nature. You cannot take a short term loan for a long term investment. That is called matching principle. Next, the relative cost and benefits of aggressive, conservative and matching funding policies, right? There are ways of funding policies. One is known as aggressive, the other one is known as conservative, the other one, right? What are the benefits and cost? Management attitudes to risk, how much risk they are able to take depends on the management attitude also, previous funding decisions, how they have funded previously, and the organization size also. You cannot just take 1 million loan if your organization size is very small. For managing your working capital, that also you have to see. Next, investment appraisal, another very important area, right? If you're very good with your section D, investment appraisal, and your risk management and a few of the theories for your MCQs, I bet that you are going to pass FM, and there's no doubt about it. But that does not mean that you don't have to focus on other area. That's not my idea, right? I don't want to promote that don't study the other areas. No, it's no. The reason I'm emphasizing more why on investment appraisal and risk management, because these are areas where chunk of calculations are there, right? So try to score most of the marks here. So investment appraisal process techniques. Identify and calculate the relevant cash flows for investment projects. Now, when you deal with projects, definitely profit will not come here. You need cash for investing for long term, right? So cash flows. Everything you deal here is in cash flows. Remember that. Number one thing is that. Next, calculate payback period. Discuss the usefulness of payback as an investment appraisal method. So one of the way how you are going to appraise your investment, whether it's a good investment technique, whether you have to go for that investment or not, is based on payback period. You calculate it. There's a method to calculate it and how it is useful. We'll see that. Discounted payback, same. Another method. You have to know this all. Return on capital employed or accounting rate of return. This is also a third method which you have to know. Fourth is your net present value. So these are the four: payback period, discounted payback, return on capital employed or accounting rate of return, net present value. Now, another thing which I want to tell here, since I have also taught AFM, so make sure that you are very, very thorough and very good with all these methods. Why? Because in AFM you have to deal with this on more advanced level. All these things will be repeated there in AFM again. So don't think you're studying it here forever and it's not never going to come again. No. That's why I always emphasize, especially the payback period, especially the discounted payback and your net present value. Net present value, you cannot skip this. AFM is all about net present value only. One whole section is there for net present value, which you have to do. There is going to be more advanced level. So if you're very good at this level now, in your foundation level, you'll be very good in the advanced level. That's why people who are very good in AFM takes AFM. AFM is an optional paper. They go and take AFM. Okay. Next, internal rate of return. This also will come for AFM, right? It's a fifth method. So discuss the superiority of discounted cash flow methods over non-discounted cash flow method, right? Why discounted cash flow is more superior. Discuss the relative merits of net present value and IRR, means internal rate of return. This is a very important area for AFM also. This is repeated. This area will come there. Next, allowing for inflation and taxation and discounted DCF means discounted cash flow. Okay. Cash flow means what? Inflation will be there. You have to see when you draw cash flow. Remember the cash flow when you draw for investment appraisal. When you are investing for a long-term project, let's say you're constructing a building, it's usually not for first 1 year only. It extends beyond that. It could be for 4 years, for 5 years, for 10 years. Usually for 10 years they will not give you, right? The max they will give you for till 5 years. They might give you for 3 to 5 years, 3 years, 4 years, or 5 years. That's the max they will give. More than that they will not give, right? So when you have to do the cash flow, you have to do, maybe let's assume for the first 3 years you have to do the cash flow. So now your cash flow this year will not be the same as next year. Why? Because of inflation. Inflation will be there next year, right? Inflation will be there for every year. So that you have to inflate your cash flow. That inflation factor has to be there, shown in your cash flow. Next is taxation. What about tax? Every year tax rate changes. But for your simplicity, tax rate will not change all the year, it will remain the same. But tax impact, tax will be there. From the cash flow, your tax will be deducted. You have to show that deduction of tax before you arrive to discounted cash flow. Before you discount, you have to discount your cash flow also. Your future cash flow, you have to discount to the present value. That's how you are going to get net present value. And if your net present value is positive, we accept the project, we say it's a good project. If it is negative, we don't. Right? So what is real term, what is nominal term? You have to know it. We'll go through this later. Taxation effect on cash flow, and also the tax benefits of tax allowable depreciation and tax liabilities of taxable profit. We'll go through all this. Apply before and after tax discount rates. Okay, coming to no, we are still in section D, but section 3, part 3 of section D, right? Adjusting for risk and uncertainty in investment appraisal. Now investment appraisal is a long-term project, right? And because of that there's a risk also, because we are not sure what will happen tomorrow. We are not sure from today, after 10 years, what will be the return might change, right? So risk is there, you have to adjust for that risk. And uncertainty is, you're uncertain, you're not sure. Then you have to plan for a longer term, and investment appraisal is a long-term project, 5 years, 6 years, 7 years. So it's uncertain. So for risk and uncertainty, you have to adjust in your calculation. We have a method of doing that also. So describe and discuss the difference between risk and uncertainty. Risk and uncertainty are two different things, right? We are for risk, we are taking some probabilities, right? And increasing the project life. Next, sensitivity analysis. This is an area, something new which you have heard, which you need to know, because even for an AFM it will come. Sensitivity analysis. What is it? We'll see that. Next, we have probability analysis. We have other techniques for adjusting risk and uncertainty, such as simulation. You are seeing the number of, you are simulating. What is simulation? You are adjusting some variables and seeing what is the outcome. You are seeing number of outcomes. That is known as simulation. In reality, it's not happening. It's like a virtual reality, simulation. You think it's real, you're just changing one variable in your calculation and seeing what is the outcome. It's like you're changing your x variable and seeing what is the impact on y, right? Next, adjusted payback for the risk and uncertainty. Next, we have risk adjusted discount rates. Okay, next we have specific investment decisions. So for investing, sometimes we have to lease or buy. We have to make these decisions whether we are going to lease or whether we are going to buy. It's not that all the time we buy. If you see the airplanes, the airline industries, do you think they buy the airplanes? No, they don't buy. They take it on a lease. Why? Because if you take it on a lease, the cost is less for you. If you're buying it outright, you have to pay a huge amount, and for that, to pay that huge amount at once, you need to take a huge loan from the bank, because obviously we will not having that huge amount. So rather than doing it that way, they are taking it on a lease, where they are going to pay the amount on installments. They are using it, the asset also, right? So, but not all the time we have to lease. Sometimes you have to buy, sometimes we have to lease. That decision, how we are going to do it, important. Asset replacement, whether we have to replace the asset or not. Capital rationing. What is capital rationing? This is a topic, right? So we have to evaluate whether we're leasing or whether we are borrowing to buy, using the beforehand after tax cost of debt. Next, asset replacement. How we are going to do it? Equivalent annual cost and equivalent annual benefit. Next, single period capital rationing. Now capital rationing, there are two types. One is single period, one is multi-period. Multi-period we are not studying in this course, we are studying it in AFM when we go to the advanced level. we are only studying the single period capital rationing. Capital rationing means your investment, you can, let's say you have 3 projects to invest. Okay, you have 3 projects to invest, but you don't have so much of money to invest all in all the 3 projects. Your the amount you can invest is limited by the amount of money you have. So now you have to take a decision whether you're going to invest in project 1, project 2, or project 3. How many projects you can invest in? Maybe 1 or maybe 2. So it's limiting. You have to decide, right? Single period means only for 1 year. Now, how are we going to do it? For that, we have to do some calculation. The profitability indexes for divisible investment projects. Don't worry, we'll know what is this profitability indexes, what is this divisible investment projects when we actually go through this. Calculation of net present value of combinations of non-divisible investment projects. A discussion of reasons for capital rationing. Why capital rationing? Section E. Now we have moved to next section, which is E, which is business finance. This is also very, I would say, a key area, because your MCQs, most of it might be based on the section E, sources and raising business finance, and it will come as a calculation also, long answers, right? Now you know when you have to do a business, you need finance. How are you going to finance? What are the sources? You have to identify and you have to discuss also, right? Finances could be medium term, short term, or long term. First, let's start with the short term sources of finance. What are the short term sources of finance? It could be overdraft. You could take an overdraft from the bank, or it could be a short term loan, or it could be a trade credit you are taking on a 3 month, or it could be lease finance, right? Now, long term. Long term could be your equity finance, debt finance, you are taking a debt, long term debt, lease finance. Lease could be long term also, short term also, depending on for how long you are taking it. Venture capital. Venture capital is not available for short term, it is a long term source of finance. And in advanced financial management, we have more sources of finance. Okay, identify and discuss methods of raising equity finance. How are you going to discuss raise equity finance? There are numbers of ways. What are those? Right issue, you could go for placing, you could go for public offer, you could go for stock exchange listing. We'll know one by one what each of them means later on the course. Identify and discuss the methods of raising short and long term, right? Islamic finance. So the word is Islamic finance here. We are also going to teach you here Islamic finance. What is it? Right? What is the major difference between Islamic finance and other forms of business finance? We'll know it. Concept of riba. Riba means, riba is an Arabic word for interest, right? Which is forbidden in Islamic finance. You are not allowed to take it. It's haram, right? So Islamic financial instruments available to businesses, including, what are those? On the next page. Murabaha, which means trade credit. These are the Arabic words on the left, and on the bracket are your meanings in English. Okay, trade credit. Then we have ijara, that means lease finance. Then we have mudaraba, which means equity finance, and then we have sukuk, debt finance. Musharaka, venture capital. Note, calculations are not required. So your Islamic finance, even in your AFM also, calculations are not required for your Islamic finance. Good thing. Only theory part. You have to write. That's it. And you don't have to write lengthy things here. So don't worry. It will be short. Identify and discuss internal sources of finance. Now, sources could be external, outside the business, or internal, inside your organization. What are the internal sources of finance? It could be your retained earnings. Maybe you have a huge amount of retained earnings. It could be your working capital. Maybe you have managed your working capital so well that your current assets, your cash, are more than your current liabilities. So from there you can take from that cash. Relationship between dividend policy and financing decision. Right? Maybe your dividend you have managed very well. So dividend policy and financing decision. Now, the theoretical approaches to and the practical influences on the dividend decision, including legal constraints, liquidity, shareholder expectation, and alternatives to cash dividends. Next, estimating the cost of capital. Please, I would say that this, write somewhere or put 3 stars in front of it. Key area. Key area, and I mean it, key area, huge amount of calculations is here. You have to know it. The reason why I'm emphasizing more and more is for AFM, it will come in a great level scale. Estimating cost of capital, you have to calculate cost of capital there, and the calculations are very lengthy in AFM. So you have to be very good here, thorough in this. Estimate the cost of equity. For cost of capital means what? Cost of equity plus cost of debt. It also includes your equity also, debt also. Both together, cost of capital. So cost of equity you have to estimate. How? Including what? How are you going to estimate the cost of equity? You need to use dividend growth model. Remember, equity means for shareholders. So equity dividend, they are related. So the word equity comes, dividend also will come. That's how you remember. So dividend growth model. Through dividend growth model, you can use cost of equity, you can estimate. And what are its weaknesses? Then systematic and unsystematic risk, what is it? You have to know. Next, portfolio theory and capital asset pricing model. What is this capital asset pricing model? Through this capital asset pricing model only we'll calculate cost of equity. Okay, there's a formula for that, fixed formula, need to memorize it, and you will be able to get cost of application of this is assumptions, advantages and disadvantages. You have to know it. Some models are very important. It's like there's no way you have to know it, which will be there later also in your AFM syllabus also. Next, cost of debt. So cost of equity is over, now cost of debt. Cost of debt could be, there are so many types of debt. You have to know all the types of debt, because you might be given more than one type of debt to calculate the cost of debt. Irredeemable debt. What is it? We'll go later when we study redeemable debt. Under that, I will teach you what is irredeemable debt. Next, we have redeemable debt. You can go and check the meaning of it also in the Google and find it yourself what it means. Convertible debt. Converting your debt to equity, your number of shares later. Preference share. What preference share is in cost of debt? Because preference share, they take it as debt only. Right? Next, we have bank debt. So overall cost of capital including what? Average and marginal. What is average and marginal cost of capital? What is WACC? WACC means weighted average cost of capital, using book value and market value weightings. WACC, another area you have to know it, you have to know it, you have to know it. For AFM also it will be repeated. Sources of finance and the relative cost. What are the sources of finance? So for that you have to see what are the risk and what are the return from that finance. You have to see the risk return relationship and also the cost also of equity and debt. Then you decide whether you will take that finance or not. Creditor hierarchy and its connection with the relative cost of sources of finance. What is the creditor hierarchy? What is it? We'll Next, identify and discuss the problem of high level of gearing. What is gearing? Gearing means when your debt is way too high than your equity. Let's say it's more than 50%. Then it's very high level of gearing, and it's very high issue because it's lot of financial risk is there, right? High amount of interest which you have to pay and all. Impact of source of finance on what? See, sources of finance, whatever you take, has an impact on your financial position, financial risk, and shareholder wealth. Because if you take, let's say you are having a gearing of 50%, on top of that again you are taking a high amount of debt. That was your source of finance, debt you took, right? This can have an impact on your financial risk. It will increase very greatly. Your financial position will suffer and your shareholder wealth might reduce. So here also you can use ratio. From your financial statement of financial position, you can use the gearing ratios to see operational and financial gearing, interest coverage ratio, and other relevant ratios. We'll cover ratios in great depth. Cash flow forecasting. Next, leasing or borrowing to buy. Impact of cost of capital on investments, including what is it? Company value. What is the relationship between the company value and the cost of capital? If your cost of capital is very high, company value will fall down. If your cost of capital is low, that means company value will increase. That's the relationship. Why? Because we use cost of capital to discount your cash flow, and that's how you find the value of the company. Later we'll learn in business valuation, right? Circumstances under which WACC can be used in investment appraisal. WACC is weighted average cost of capital. Cost of capital the same. Advantages of CAPM over WACC, right? In determining project specific cost of capital. CAPM, capital asset pricing model, we use to find cost of equity. WACC is cost of capital, right? Where we have both cost of equity and cost of debt. Next, application of this one in calculating project specific discount rate. Next, we have capital structure theories. Now, this theory is also very, very important. You have to know it. Okay. Describe the traditional view of capital structure and its assumptions. Miller, Modigliani view on capital structure. Who are these? What are their views? We'll know it. With and without tax and their assumptions. Identify a range of capital market imperfections and describe the impact on the views of M and M. You can even say M and M, Miller and Modigliani, right? On capital structure. What is this pecking order theory? And the selection of source of finance. Through this pecking order theory, you can select your finance, source of finance, right? There's a way through you decide that this is the first we go by this, next we go by that, third we go by this, right? Next we have finances for SMEs, small and medium size enterprise. So what are their financing need, right? Describe the nature of financing problem for small businesses. Now you all know that very small businesses, let's take for example a small barber in your hometown. For them, financing is a huge issue. Why? Because they do not have such security to provide as collateral to take a loan, or they do not have such asset to which they can show, or they are not being reliable that they will be able to pay back their loan or not. So they have a huge financial problem issue, small businesses, right? What is this funding gap, maturity gap, in inadequate security? So inadequate security is exactly what I have told you now, just now. Because of that, funding gap is huge. They need huge amount of finance, but they are not able to take that, right? But big businesses, large businesses have that advantage that they can go for any source of finance. Everything is available to them, open to them. So explain measures that may be taken to ease the financing problems of SMEs. How can you ease this problem? You can even take the responses of government departments and financial institutions. Evaluate, identify the financial impact of source of finance for SMEs. Business angel financing, what is it? Government assistance, government can assist supply chain financing, crowdfunding, peer-to-peer funding. Next, we have business valuation, which is section F. So, nature and the purpose. Now, business valuation is also very important. You have to be very, very thorough and good with this, because one whole section for your exam will come in AFM, which is on business valuation only. Remember that. There you will struggle a lot if you don't work hard here. Here it's much easier and simpler, but there it will be in more advanced level, right? So nature and purpose of valuation of business. How are you valuing the business and the financial assets? There are methods of it. The calculation is here also in this topic also. Right? Why do you value business and financial assets? And what are the information you see? You cannot value something where you do not have information about. You need information also about that business to value them. So what are the information requirements? Right? And information are of different types. So because of that, there are limitations. What are the limitations of it? Models for the valuation of shares. Very important is this. What are the models for valuation of shares? One is asset base. You can value a company or share using asset as the company. How is it? Net book value. From the financial statement only you can take the assets. Net realizable value basis you can take. Net replacement cost basis you can take. Next, income based. You can take income base. Based on your income you can value. How? These are the methods. Price earning ratio, PE ratio. It will be given to you. Or earnings yield method. Or you can go for cash flow. When you go for AFM, there will be more methods to this, and it will be in more advanced level. More will be there. Cash flow. Another way is cash flow. Cash means dividend valuation model you can use, or dividend growth model. Next, discounted cash flow basis. Valuation of debt. How are you going to value the debt now? These are the methods. Irredeemable debt. There's a method to value this. Right? Irredeemable debt, redeemable debt, convertible debt, preferential. We have gone through this before also when we went for the debt, right? Section F. Efficient. Now this section 4 is not there in your AFM. It is only there in financial management. So this definitely will come for your financial management. One of the question. That's why it's important. Efficient market hypothesis and practical considerations in the valuation of shares. What is efficient market hypothesis? Efficient market hypothesis assume that market is perfect, market is efficient, market has all the information needed, and market reacts to the information. But we know in reality it is not so efficient. It is right. There are market failures. Now there are three types of efficiency. One is weak form, one is semi-strong form, one is strong form efficiency. What are this? We'll learn it in this course. Something which is new to you, and I'm sure that you haven't gone through this. Discuss practical considerations in valuation of shares in business, including marketability and liquidity of shares. So you just cannot value any shares, right? If the shares are not so marketable shares, right? Unquoted shares is very hard for you to value those shares. Remember it. So when you have to value share or business, there has to be market for it, where you can sell or buy shares easily. Liquidity has to be there. Then it's easier for you to value those shares. Availability and sources of information. You need great source of information for you to value, right? How do you think, how does the share market operates? The one who goes the share price, it goes up and down. How? Because they have information. The one who has great amount of information, the first one to have the information, they're benefiting, they are an advantage. Market imperfections and pricing anomalies. We know market is imperfect. Market capitalization. So the significance of investor speculation. Investors, what do? We speculate that prices will go up based on something, or based on the past, or prices will go down, right? Which is also known as behavioral finance. What is it? Because of this theory, some of the investors, they assume prices will go up, some will assume prices will go down, right? Next we have section G. This is the last and one whole question for your AFM is on risk management. So if you're very good in risk management, you have nothing to worry in AFM also. I can even advise you to go for an AFM after FM, if FM is your last paper. So risk management. What are the nature and types of risk and approaches to risk management? Now, when we are talking about risk management, here we are discussing two types. One is foreign risk, currency risk. One is interest rate risk. These are the two risks we are managing here. Okay, what are the, because especially when we are dealing with foreign country, right? When we have a subsidiary over there, when we are buying and selling from there, we know that when we receive in currency, that currency might change in value. Let's say we have bought a good, but we'll receive it. Sorry, we have to pay after 3 months. We are paying and buying in foreign currency. Remember, when we convert it in our home currency, it will change in value. Why? Because the currency rate, we know it will change in 3 months, changes every day. So if the currency rate goes in our favor, and if we have to make the payment, our payment after 3 months will be reduced in value. It will be costing less to us, which is good for us. But if it's the other way around, exchange rate changes worstly for us, where our payment will be more expensive in 3 months from now, because of the exchange rate changes. So how are you going to manage that risk? It's an uncertainty. We don't know whether currency risk, right? The exchange rate will go up or down. It keeps going up and down. We cannot know. Because of that, we have to manage this risk. There's a way of managing it. It is also known as hedging. How are you going to hedge the risk? Right? So, same for currency, even for interest rate. Interest also keeps going up and down. One is known as foreign currency risk, translation risk. What is it? Transaction risk and economic risk. Translation risk comes when you convert your financial statement at the end of the year. You have prepared your financial statements in foreign currency, you will convert it in your home currency later, right? There some differences will be there. So because of that, either you might have exchange gain, currency exchange rate gain, or a loss. So that is known as translation. Transaction is the one where we are dealing in right now. Transaction risk occurs and then we hedge it. Transaction risk means after 3 months or 4 months, even if we don't do any dealing in it, we are exposed to the risk. Why? Exchange rate will change, right? We have to pay in the future, so in future exchange rate might go up or down. Economic risk is a risk which we cannot hedge usually because it's a long-term risk. Maybe the country suffered, their competitiveness reduced of the country, so because of that their currency risk, their currency value went down, depreciated in value, so that is known as economic risk. But mostly we are dealing with transaction risk here. Discuss the types of interest rate risk. What is interest rate risk? Gap exposure, basis risk. You have to know this basis risk. Next, what are the causes of exchange rate differences and interest rate? We have to know it. Why it changes, fluctuates. Balance of payment. Purchasing power parity theory. These are the theory which you have to know. It's also applicable in your AFM. It will come there. Interest rate parity will also come there. AFM. You have to know this. Four-way equivalence. This will not come there, but purchasing power and interest rate parity, this two will come in AFM. But for FM, you have to know what is four-way equivalent. You have to forecast exchange rate. How do you forecast? Using purchasing power parity and interest rate parity. This is exactly what we are doing in AFM also. Next, describe the causes of interest rate fluctuations. Why? Structure of interest rates and yield curves. What is this yield curves? We'll know it. Expectations theory. What is it? Liquidity preference theory. Market segmentation. Now coming to hedging techniques for foreign currency risk. Right? What are the basic method? We have currency of invoice. Maybe the invoice which you make the currency, you can tell them to make it in your home country so that you don't face any foreign currency risk. Next, netting and matching. What is netting? All your payments and receipts, if you have in one particular currency, you can net off your payment with your receipt so that you only deal with net payment or net receipt. Matching is when you are taking an asset in one currency, liability also make sure that it is in the same currency so that there is no foreign currency risk there. Leading and lagging. You are paying earlier or you are paying later. Lagging means you are paying later, leading means you are paying earlier. Because you know later the foreign currency risk will go up or down. Next, forward exchange contracts. So we are going to use forward. Money market hedging. All these are in your AFM. All these are there in your AFM. Asset and liability management, right? But there we have more, right? We have swap, which is not here. We have options, future. We have to compare and evaluate which one is the best out of it. Next, identify the main types of foreign currency derivative used to hedge foreign currency risk and explain how they are used in hedging. No numerical questions will be set on this topic, remember. So great news, no numerical questions, but in AFM, numerical, it is heavily numerical only, right? Next, hedging techniques for interest rate risk. How are you going to hedge? Matching and smoothing. Asset and liability management, forward rate agreements. There also we have forward in currency, interest rate also we have forward, but don't confuse between the two. Forward is two different things, right? Next, and this is the last slide. Identify the main types of interest rate derivatives used to hedge interest rates and explain how they are used in hedging. No numerical questions will be set on this topic. Same like exchange rate, no numerical questions. So great news. So with this, I have ended this video here. So all this were the topics which will be asked for you in the exam, in your FM exam. Now, my next video, please do check my next video. It will be on the revision. It will be on your exam paper, the outline, how your exam will be. I will show you a sample of an exam paper, how it will come, right? So your exam paper is divided into three areas: section A, section B, section C. Section A, I don't remember whether it's 20 or 30 marks. For how many marks it is, it will be MCQs. And section B and C, C is the long question answer, and B is it is also multiple choice, but not multiple choice question. It is like multiple choice response, something like that. So we'll cover it in the next video. Till then, don't forget to subscribe to my channel and make your friends also subscribe to this channel and make my channel reach 1K subscriber. Thank you and you take care. God bless you.